So what is today's business sentiment in the U.S.? There's fear over emerging markets, the U.S. economy, and the prospect of another debt ceiling battle in Washington all hit shares hard in Asia. Turmoil in some emerging markets reflects a failure of advanced and developing economies to learn from the financial crisis and coordinate economic policies in a better way. A senior Bank of England official was actually stating this the other day. Individual countries act in their own best interest without taking into account the broader best interest of the financial system as a whole. This is our problem. So what is going on with the head-to-head combat is people pursuing policies of individual countries. What is at stake? Is the system as a whole? At stake this is now after India's central bank chief, Raghuram Rajan, who said that the international monetary cooperation has broken down as the Federal Reserve tapered and or slowed its bond buying stimulus program, despite the recent upheaval in emerging markets. Now, let's analyze this. The United States stocks opened higher and were rising on Tuesday, and the European indices were recovering after Wall Street had its worst day in the year on this past Monday. Taking a look at this, the European markets fell in morning trading, but by the close they had stabilized, closing a bit lower. The Euro Stoxx 50 index closed down 0.5% and the FTSE 100 index of leading British shares fell 0.3%. The stocks in the United States opened higher. They were helped by corporate results. At midday, the Standard & Poor's, the S&P 500 stock index was up 0.7% to 1,754. The Dow Jones Industrial Average went up 81 points to 15,453, and the Nasdaq, believe, increased 38 points to 4,035. The tumult occurred amid continuing signs that the turmoil in emerging markets is spreading to the developed world. So how do we look at this? Asian markets sustain a difficult day, with the Tokyo benchmark Nikkei 225 stock average down 4.2% to its lowest close since early September, and the Hang Seng index in Hong Kong 2.9% lower. Investors have been bailing out of Japanese stocks as the country's currency, the yen, has risen. Investors fear that the strong yen, which is the result of a flight to quality from the instability in emerging markets, will take a bite out of the corporate profits and undermine Prime Minister Shinzo Abe's economic revitalization program. The yen is a key reason. We have to understand this. The selling accelerated in New York after a survey of the manufacturing industry showed production had fallen to its lowest levels in 8 months. It was the latest indication that the broad-based equity rally that made stocks a stellar investment in 2013 might have run out of steam. Broadly, what we're seeing is a flight to quality, away from emerging markets into U.S. treasuries and other safe assets. I personally think we'll continue to see these flare-ups, but I don't think that the case that investors will flee emerging markets to the extent that there's another crisis. We shall hope so.